Hi, I'm Kison with Fundology. Today I'm here with Brad Ashley with PRIVEQ Capital Funds, a Toronto-based private equity firm. How are you today, Brad?
I'm doing great, Kison. Thanks for having me.
Great. Brad, could you tell me a little bit about PRIVEQ?
Sure. PRIVEQ is a private equity fund based in Toronto that I started about 20 years ago. We're currently investing out of our fourth private equity fund, focusing on lower mid-market transaction, primarily in Canada and into the U.S. About 50% of our deals are buyout deals, and the other 50% are expansion capital deals. And our focus is really on helping entrepreneurs grow their businesses. Our size of investment is typically initially in the $3 to $10 million range, focusing on companies that have revenues of $10 to $100 million and EBITDA of $1 to $10 million. And they're pretty niche businesses. There's something pretty special about them. And the question we always ask is, if the company disappeared, would anybody care? Suppliers, customers, etc. If nobody cares, it's probably not a niche competitive advantage business that we want to invest in. But if somebody would care, that's the kind of business that we focus on.
Great. Now, how'd you get into the industry?
My background is I'm a JD MBA. After being called to the bar, I did some banking, international banking, and then a couple years of mid-market M&A, and then worked with another private equity fund for 4 years from 1990 to 1994 before setting up PRIVEQ back in 1994. And as I mentioned before, we've been in business for 20 years now.
Wow, so you've seen some cycles in the industry.
Ups and downs. We've seen a lot.
Great. Well, Brad, I want to talk to you today a little bit about an expansion deal you've recently worked on, and if you want
Sure.
to give me a little background about that transaction.
Sure. The most recent expansion capital deal that we completed was a business in southwestern Ontario by the name of Accipiter Radar Technologies. It's based in the Niagara area, and it is primarily a radar information system that tracks small uncooperative targets. And it actually focuses on three verticals. One of the verticals is Homeland Security, a second is avian safety, and the third is environmental. So when we talk about Homeland Security, we're talking about patrolling the Great Lakes and watching for movements of boats across the lakes and watching for strange movements. We've actually also recently landed a major contract with the Border Patrol, helping to monitor the southern U.S. border for ultralight aircraft maneuvers. The next is avian safety, which is watching for birds around aircraft. Everyone remembers Captain Sully on the Hudson. Well, this is a technology that can detect birds that are around airports that hopefully will prevent airplanes from taking off into birds and causing both aircraft damage, which is quite expensive, but even more importantly, prevent civilian casualties that could result from a bird strike. And then the third area that we focus on is environmental, keeping birds and other wildlife out of environmentally sensitive areas. For example, the oil sands. We have deployed our system for both detecting wildlife coming towards tailing ponds, and also we have deterrent systems for keeping wildlife out of these tailing ponds. So that's worked out quite well in the oil sands. And in Alberta, we're also looking at wind farms and other environmentally sensitive areas that we want to keep birds away from. So those are the three verticals that Accipiter focuses on. And so we're very excited to be involved with the business. We came in to provide some growth capital to fully exploit the opportunity the company had across these three verticals. That was most of our capital that went into the deal, provided that growth capital. A small amount of our capital took out an initial shareholder that was passive and needed to move on, given it was deep into its fund life. So they chose us as a partner to help take the company to the next level, and we're absolutely delighted to be a partner with the management team in this venture.
Wow, this really sounds like an interesting company. Could you tell me a little bit about the size and where they're located?
Yeah, so it's It's north of 10 million. It's between 10 and 15 million in revenue right now, and it's growing quite rapidly. And again, it's based in southwestern Ontario, about half an hour from Niagara Falls.
Okay. Now, Brad, how were you introduced to this deal?
So this deal came to us through a small intermediary, a small broker working in the Niagara area. They knew that this passive shareholder, initial shareholder, wanted to move on, given again where it was in its fund life, and they knew this company had huge potential and really needed capital to accomplish both objectives. They came across us through previous dealings. They've shown us previous deals in the past. And when this deal came up, we were just all over it. It was a perfect PRIVEQ deal.
Great.
Had our name all over it.
So from the first time you're introduced to the deal, can you tell me about the steps that followed and up until the point when you actually started negotiating with them?
Yeah, so we went through a usual process of due diligence. We met with the management team and really liked the team that we saw. It's an outstanding first-class team led by a fellow named Tim Nahara, who's an incredible manager, and he's deep with other management expertise that have really propelled the company to where it is today. So we spent a fair bit of time with them, making sure that we were comfortable with them and they were comfortable with us. We also did the usual kind of accounting due diligence and tested out the competitive analysis as well to make sure that this was a space that had the potential that management shared with us that they thought it had. And so once we proved all that out, we proceeded with a letter of intent and had a fairly quick negotiation with the management team who owns the rest of the shares. And as that went fairly smoothly, we moved on to and signed that up, moved on to our secondary due diligence, which was primarily to prove out the pipeline. The company, as I mentioned before, is at an inflection point, and we really needed to make sure that that the orders were coming through that were in the pipeline. While the customers were telling us that this was a product that was needed in the market space, we want to make sure that that was confirmed. The next thing is, as I mentioned, while the team was outstanding, to fully exploit the opportunity, there were a few gaps that needed to be filled, and we had to work with the management team to fully identify those opportunities and start working on that 100-day plan so that once we did close the transaction, we could hit the ground running and start to fill some of those positions immediately. And then finally, while we were checking them out, doing final checks on the management team to make sure that they really were who they said they were, we wanted to give them time. And we encourage this in every one of our deals. We encourage the management team to check us out fully to make sure that we're the partner that can really help them get to the next level, and they're confident in our ability to do that. And they do that by contacting a number of our current and previous operating partners.
Very good. I'm curious to know, how do you, during the due diligence process, how do you confirm those orders?
Well, we spoke with customers, and in a couple cases, we actually waited for the formal order to come in. There are a couple of very significant orders that we needed to see actually get confirmed by the customer, and once those were confirmed, we went from an orange light or yellow light to a green light, and went very quickly into closing mode.
Okay. To back up a little bit, how do you value this transaction? Are you basing it off a multiplier?
Yes, we are. We are. We're looking at the company was a profitable business, very profitable business, and we used a quite reasonable growth multiple that, again, the management shareholders were comfortable with and we were comfortable with. And it was a small negotiation to come up with a final number. We also provided the management team with an extra earn-up such that if we get extraordinary returns off this investment, they'll do particularly well. So we put a little extra carrot in front of them to further enhance their returns, assuming that we get some pretty good returns ourselves.
Great. Now, when you look at the transaction, is there going to be a different multiplier on an expansion deal versus a buyout deal?
It really depends. I mean, we have to take into account the competitive situation. If it's a full auction, are the strategics at the table? What alternatives do they have versus, how desperate are we to get into this transaction? unless we're looking at it as a specific platform to go forward, really the multiple should be the same across those two spaces. Again, only subject to the competitive nature of the transaction.
Okay. Going back to due diligence, were there any other surprises or challenges that came up during due diligence?
No, it really was the pipeline fill, and again, just locking down what we all felt was needed in terms of growing the management team, which wasn't that complex to figure out in the end. But we really just need to confirm the backlog. The information systems in the company probably need a little bit of work, and that's not surprising given the size of the business. But the team was very cooperative in working with us to ensure that post close the proper systems would be in place.
Okay. Now, post closing, what's your strategy as far as growth and value creation?
Sure. So the first thing, as I mentioned, is we put together this 100-day plan, as most private equity firms do, and we want to really make sure that we hit the ground running post close. We immediately started the key hiring process, and there were three key hires that we needed. Amongst a number of other hires that we were in process of doing. But the three key hires was, first of all, making sure that we had a new VP Sales and Marketing to, again, fully exploit and professionalize the sales and marketing functionality of the business. The sales and the growth that they had so far, came from, I guess, more rudimentary kind of processes to get them to where they were, but to fully exploit the opportunity, they need to step that up a notch. And it was incredible how they got to where they were, but they recognized they needed help to get to the next level. So we made that hire a few months after close. We also hired a chief legal officer, given the bid process in a number of these initiatives and securing of some leased real estate for some satellite nodes, some radar nodes in some geographies where we effectively need to tie up some property. We decided to hire a chief legal officer to basically take some of these responsibilities off of the CEO's plate to free him up to do some more important strategy. And finally, I think I mentioned before, we needed some help on the information system side, and we bulked up that area as well with a key hire. So on the hiring side, those are now in place, and we're quite pleased with it. We're also in process of setting up an advisory board to provide both expertise and context to go after each of those three key verticals as well. And we started that process, and it's still in place. We're still growing that team. We're also working on developing a model. There's a few different ways to go to take advantage of the opportunities depending on each of the verticals that I mentioned before. And we want to make sure that we have the right model to be fully scalable within each of those sectors. We're also assisting on the merger and acquisition side. While the key focus right now is organic growth, there may be a few neat tuck-unders that may come to us. We've identified a few already, and PRIVEQ will lead the initiative to both help identify those through our network as we broadcast that we've been involved in this new investment. All our contacts will know about that and hopefully find us some neat tuck-unders, and we'll obviously help with the negotiation, due diligence, and closing of those transactions. And finally, as an overall strategic sounding board, helping work with the management team, who, by the way, we work with in a very cooperative way. It's worked out really, really well post-close. So we're a sounding board to the CEO as he wants to bounce some ideas off of us, and also, we have a good rapport when it comes to developing strategies for our go-forward strategy.
Great. Could you tell me a little bit about your process to source those key hires?
Yeah, for the CLO, that was an internal hire. We had a number of candidates that were close to. I'm a lawyer by profession, so I know a fair bit of lawyers that are looking to get into industry. The CEO was close to a number of lawyers in the geography where the company operates, and we put that list together and identified one person that accepted our offer, and he's has worked out quite well since we hired him. With respect to the VP Sales and Marketing, given this role was quite technical in terms of who we're looking for, and we want to make sure that the person had some experience across some of the verticals, not necessarily all of them, but across some of the verticals that we're targeting. We hired an international headhunting firm to assist us, and they did an excellent job in identifying a number of candidates. And again, we brought it down to one, and we were very successful in landing our top prospect.
Very good. In your experience, Brad, have you had better success hiring through your network versus doing an extensive search, or vice versa?
Yeah, it's we've had success on both sides. Find LinkedIn's an excellent tool for identifying people within the network, letting people know that we're looking for somebody, and through word of mouth, quite often we can have some good success. When we're looking for that particularly technical hire for that VP Sales and Marketing, though, that would be real hit and miss through our own network, and that's where we need to seek out some expert third-party assistants who do this for their day job.
One thing I really wanted to talk to you about is really contrasting the difference and the differences and intricacies between doing an expansion deal and a buyout deal.
Yeah, I mean, that's a great question, and given we do 50% of each typically in our funds, we've had good exposure with both. Expansion deals are actually easier deals to get done. There are way more buyout opportunities because so many more companies are being sold. It's rare that we'll find an expansion capital deal that isn't just financed by bank debt. And where somebody actually wants an equity partner in the deal. But once we find those, they're much easier deals to get done. First of all, from our perspective, we're much more comfortable with them, typically because there's less risk in the transaction. There's less management risk in the transaction, in that we're not cashing out the management team who took this company to its current success. We're typically backing them as they continue to grow. And as a result, we don't have that non-aligned situation. We have a fully aligned situation. Typically, management is not cashing out. They're staying fully invested, unlike a buyout. And so we're very comfortable putting in capital beside a management team that already has both their sweat equity and likely significant personal equity invested in the opportunity. Also, given we're not changing management, we're backing the same management, assuming there was good success in that. We don't have to do as much homework on the management side to make sure that a new manager coming in, will definitely fit the culture of the current organization, can do the job, knows the industry, etc. We already have all of that in place. So it takes one massive risk off the table and allows for much better alignment out of the chute. We also find they're much less complex deals. There's not usually third-party banking that's required. There aren't nearly as many approvals that are required, third-party approvals. So the docs are much easier in terms of getting the transaction closed, and there's fewer negotiations that need to be done. And again, given there's fewer third-party approvals that are required, the risk of not getting a third-party approval doesn't exist the same way. So the deal risk is substantially less than an expansion capital deal.
Which one have been financially better for you?
It's a good question. I mean, we've had very good success with buyouts, but again, given the lower risk profile on the expansion capital transactions, I think generally the volatility around expansion capital deals is a lot less, and there's less chance of downside in an expansion capital deal compared to a buyout deal. So I would say on the whole, expansion capital deals have been quite successful for us. And again, we've had good success on buyout too, but expansion capital deals are safer, easier, quicker, and typically generate some excellent returns for us.
Now, have you had expansion deals that later turned into opportunities to buy the company out?
Yes, we have had those, but quite often, again, given we're a private equity fund, given that we're only typically in a deal from 4 to 7 years, management and our fund are typically exiting around the same time. Sometimes management might stay on longer than us. So it's rare that we'll get involved in a situation where we've invested as an expansion capital player and we're buying out the management team. Typically we're exiting at the same time or that whole lot longer than us. The only time that happens would typically be if management becomes incapacitated or has some personal challenges and needs to move on, or we have a real problem with the management team and we have to change them out. In that rare situation that happens, then we buy out their position. But typically when it's working well, we either exit at the same time or management takes us out in another transaction, again, 4 to 7 years down the road.
Great. Brad, that's all I have. I appreciate taking the time to share the insights with us. If you want to share some of the deals you're looking for, I think we have time for that.
Well, that's great, and thank you so much for having the opportunity to share the exhibitor story with you. We're delighted with that one. Again, at PRIVEQ, we continue to look for both expansion capital and buyout deals, revenues $10 to $100 million, EBITDA 1 to 10, and something really special, something niche, like Excipitor being the leader in its space. We're looking for those neat stories that need some capital and need the expertise that we have at PRIVEQ to really help them realize on the taking full advantage of the opportunities that they have that they might not have been able to realize before, whether that's through help with M&A, strategy, sounding boards, building up the advisory board of the company, helping with key hires, whatever it might be. We'll roll up our sleeves and really work in an extremely cooperative way with the management team to allow the company to fully realize on its potential.
Great. Now, any industry or geographic focus?
We're focused on niche manufacturing, service, and distribution. So again, really more niche. We're not going to do retail. We're not going to do technology. We're not going to do real estate or commodity products. Geographically, closer to home is always better than further from home. We can do up to a third of our fund in the U.S., 2/3 of it in Canada. We save 5 hours maximum travel time from Toronto, and that includes everything from airplanes through driving and walking. So we don't want to take 3 planes to get to an investee company, but if it's reasonably close, within 5 hours of combined travel, we'd be delighted to take a look at it.
Great. Thanks for the time, Brad.
Thank you very much again, and appreciate you having me on your show.